Okay, this one's going to be another kind of catch bottoms trying to ride all the way to tops, and they kind of miss the point, especially what I'm trying to teach in our Discord server. The general idea is that if you were to take Elliott in its simple format, you start to realize we get a base formed. Now, this base could be Wyckoff, it could be just an accumulation phase, it could be a distribution phase. It's almost irrelevant in terms of what it is that this is. What we're seeing is consolidation, okay? So that's kind of step one. Now, when you think of what Elliott does and the way that Elliott moves, is let's assume that we're going up, right? And I'll use Bitcoin as the kind of example because we've just been riding a Bitcoin move as a whole. So we've got some kind of base, okay? This is going to be my zero level. I'm going to get a low. So whether it's a spring, whether it's another Elliott move, it's kind of irrelevant, right? The general idea is that we go in from the base and we're moving up quite impulsively to a one. Okay, so this particular one is where the big institutes have actually said to themselves, okay, we've now accumulated enough, we're ready to move on up, we want the price to be pushed up, and we're going to jump in. So these guys jump in. Now at this point, the retail are under no assumption that we're in an uptrend. This has probably come from a downtrend as a whole, and therefore they're assuming that the market is going to be a continuation pattern and we're going to move on down. We get this impulsive move up, right? Now at this point, we are looking for pullbacks. So as a retail trader, most retail traders will be looking for a nice pullback, and the idea at this stage is maybe we're still in this downtrend because the assumption is going to be we've moved from, let me put this marker on, we've actually moved from a downtrend, we've pulled back, and it looks like we're going again. Okay, so a lot of retail will jump in this thinking, I'm going to short at this point with a bigger downtrend. Okay, now the logic is when you understand that we're actually looking at an Elliott impulsive move up and a pullback down. Now, what tends to happen with a pullback on something like this is a two move is actually quite clean. And what I mean by this is that we tend to find in a pullback move 1 to 2, you often find a B, and a C move. Now, I'm not saying it's always, but this happens more often than anything more complicated because what a 2 actually is and what it represents, it's just a sell-off, right? Now, if we were to assume that we've had this impulsive move up, now what tends to happen after any channel break or line break or crossover or moving average, whatever you want to use, you ultimately tend to find that you'll end up with an impulsive move and a pullback and then a continuation pattern, right? So we quickly get to see this type of move across the board in any instrument, every instrument as a whole. Now, it's not until this stage that the big boys have actually gone, they've accumulated their position, they are keen to force the market upwards. Now, at this particular point, we've got retail traders now thinking that this was the pullback and it's a short selling down. They might be in there and thinking, great, wonderful, this is going now back through this level. So you end up with another kind of spring type effect into pushing the market up to 3. And at this stage, all we're seeing is inside the actual bigger time frame, we're now getting to see a 1, a pullback 2, an impulsive 3, a pullback 4, and up to 5. So this obviously fractal is the similar kind of thing. We're going to be seeing this impulsive move. We're going to be seeing an aggressive pullback followed by a bigger impulsive move. This thing happens over and over and over again. Now, as a retail trader, they start thinking, well, I was in a short position here. It hasn't gone down as deep as I would have liked. We're in this position. Some of them will hold on and it becomes stop lost at this particular point. Some of them will profit a little bit because you've only got this very small move and these guys have got lucky. The reality is they now start to think, hey, perhaps we are in an uptrend. We've just breached this high in this position here. Maybe we're going to go long. Okay. Now, on the assumption that these guys are going long, price has moved up. What do you think is going to happen? We get an aggressive 2, kills the stop losses on the long positions, obviously then fueling another move up. Now we get the 3, At this point, the bigger players are looking to take profit. So 4 becomes often irregular. It becomes obviously the opposite to what we saw in 2. So if we tend to see a very complicated 1-2 move, then 4 is going to be pretty simplistic as a whole. And you might get an ABC pattern rather than triangles and wedges and flats and all these other scenarios that people like to discuss. Now, the problem is, again, for me, this is just noise. It's just, silly, crazy, wasting time trying to work out where the next bottom is going to come in. It's just a waste of everybody's time. So I think the general idea is that once we know that we've got a decent 2, then we know 4 is going to be kind of drawn out. So a couple of things we know about 4 is, unlike 2, where 2 was actually a sell-off, 3 to 4 is actually profit taking. We've made a lot of profit from this move 2 to 3. And what we're looking for is a new foundation, a new base almost, in terms of going on the way to 5. So we're going to get accumulation as a whole. We also know that we've got a drop down here would invalidate the count. So we've got a couple of factors. We also know that on average, the pullback level from 2 to 3 is around 38 to 50%. So it's less aggressive than 2, where you're actually seeing 60% or more on 2. And therefore, the move on this one is going to be something that we're looking for a very slow, drawn out process. This confuses a lot of retail. It gets people thinking this is the end. It makes people think this is now a bear market rather than a bull market. And all we're actually doing is kind of accumulating all the way down, really. So when you look at the Bitcoin example, a lot of people said to me, oh, why is the buyer's climax at 44? Well, if you're an institutional trader with billions on the books, the problem that you have is if you try selling billions at the all-time high, you're going to have a drop that looks something like this. So the general idea is that they start to take their profits at a buyer's climax, and ultimately it allows them to take profits a little bit higher, a little bit lower, a little bit higher, actually receiving an average price. Now, this isn't rocket science, it's an average price. These guys have actually bought in from down around here. They've bought in from down around here. And therefore, profit taking at this level is kind of logical. So getting this in rather than trying to catch the tops and the bottoms means that they've got an average buying price. They've actually got an average selling price. They're probably overlapping in some way, shape, or form. And the idea is that once they've now distributed what they were kind of holding from down here, they're going to be looking to accumulate again at a slightly lower price than they've obviously just sold off at. So now they've got profits. Retail are jumping into the fear factor. They're jumping off a cliff. And the general idea is that as an institutional investor, we can go again and actually take now another impulsive move to the upside based on the same concept. So we then have an impulsive move up to 5. This is going to create an all-time high. Even if it's only, $500, $1,000, it's almost irrelevant in terms of what it is, because right now the market is trading at what, 31,780 as we speak. I'll put that like this. So, the general idea is if we can move all the way back even to 64,500 kind of level, it's not a bad trade as a whole. Okay, so when you then go inside this again from a fractal nature, you're going to see another 1, an aggressive 2, an impulsive 3, a pullback 4, and a move up to 5. So even if we assume worst case scenario, 3 and 5 become almost equal height, we're still going to see a 64,000 plus in terms of the move up, unless we get a breach of this level here. Okay, so the general idea is, for me, stepping into a 4 position, the lower we get to this particular level, the better the entry. But what I'm actually looking for is not so much the entry on trying to catch the bottom. What I'm actually looking for is an impulsive move up, followed by a pullback down, and I'm looking to obtain an entry at this position on a 2 move, which gives me 2 to 3 as the impulse, but on a much bigger 4 to 5 move as a whole. So hopefully that helps in terms of the logic and the understanding of what's happening within these markets and within these cycles, and why it's less important trying to catch the bottom, and why it's even, even more frustrating in terms of trying to figure out, what patterns doing what levels doing this, whether it's an A, an X, a Z, a Q, it kind of doesn't matter. I think the general idea is what I'm actually looking for is an impulsive move to the upside with an aggressive pullback. And once we see that, we've got some kind of indication that we're actually now going from 4 to 5. And that's what I'm actually looking for. So again, I hope this helps.